Hello everyone and welcome to this week's webinar. My name is Andrew Green. I'm the Customer Success Director here at Nimbus Maps. I suppose first things first, you're probably expecting Paul. Paul's unfortunately got a personal appointment this afternoon, so he's unable to make it. So maybe luckily for you all, you've got me instead, but I'm sure Paul is well loved. But who we also have here today as well to run through the top 3 creative ways to buy and fund sites is the one and only Mr. Ian Humphreys, who is co-founder of Brickflow, which is a platform to help you get funding on your sites. Welcome, Ian. How are you doing?
I'm good, thanks, Andrew. How are you?
Yeah, very good, very good. Seems to be dodging COVID so far, which is always...
Yeah, that's literally what I'm doing, just staying in the house, trying not to get COVID before Christmas. But yeah.
Indeed. Right, before we crack off today, I suppose, I know normally we sort of ask a lot about, why we started all these things, but I thought we'd start with a different question today, just to sort of break the ice a little bit. Sure. Do you want to sort of talk through, because I'm sure maybe people have heard before, I know you've been on a webinar with us before, about how you started Brickflow, but do you want to talk about through the best deal you've done, or the best sort of the most interesting case you've had to work on, or something like that?
Yeah, sure. Do you want me to intro Brickflow as well?
Yeah, give a little intro to Brickflow and maybe talk about one of the sort of most interesting.
Yeah, sure. Yeah. Okay, so Brickflow is a comparison site for development finance. So first one in the UK to do that. So taking the kind of money supermarket approach to development finance is probably the easiest way to describe it. And I think the key part to understand for people is because the loan sizes on development finance are generally bigger than, say, a residential mortgage, the actual savings between the middle part of the market and the sharp end of the market are huge. So for most developers, the difference between finding finance and finding the right finance, which is what our platform does. So just to confirm, so we've got 37 lenders that feed their criteria and pricing into the platform, and then our algorithm searches those lenders against the project details you enter into the platform, and then we shortlist lenders according to who's most likely to lend to you, the amount they're likely to lend to you, and then what you do is you shortlist your favorite 5 lenders from that list, and then you add your project documents, so your CV, your development appraisal, planning documents, anything like that. And then we invite those 5 lenders to bid on your project. So it's like a competitive tendering process. But what it means is you get best value. Lenders know they're in a competition, so you get best value very quickly. Normally that process, even for someone like me who knows the market, to go to 37 lenders and get the best price from all of them would take me months. On the platform, we do it in 2 minutes. And then the bidding process normally takes no longer than sort of 4 to 48 hours is kind of the time it takes for lenders to bid. So we've compressed a sort of 3-4 month process for most people into a couple of days, which is a great time saver. But going back to my initial point is, for most people, the difference between finance and the right finance is normally hundreds of thousands of pounds in terms of deposit and savings in interest costs. So, and that's pure profit for a developer. So, especially in a time or an environment where margins are getting tighter, if you can get an extra couple of £100,000 just by using the right finance rather than any finance, then that makes a big difference.
Yeah, I think, like you say, it's having that sort of tendering process, I think, at every step of the journey, isn't it? Like you'll always get 2 or 3 quotes for subcontractors and everything else. It's the same as saying, well, don't just take the first deal that you get, on your finance as well.
I think that's it. But up until now, it's just taken so long to get each lender to engage and give you what you need. So people tended to just go to 1, maybe 2 lenders, and that's really all they did. But when we've got 37, I mean, there are actually more. The 37 we have are lenders that we trust and are reputable. But the breadth of the difference between, like I say, number 1 on the list and number 37 will be huge. And if you're speaking to, number 30 on the list, and that's the only person you're speaking to, you might be missing opportunities because you think you have to put too much money in, or the finance is too expensive. Whereas actually, the finances can cover, cost overruns in other areas. So it's going really well. We're just over a year old now. We've just done an integration with yourselves, developer feedback, lender feedback is strong on both sides. But to go to your point about interesting cases, quite a few that I can think of, but the one that really comes to mind this year is a case for a developer in the Midlands. So they're building 63 units in a 2-phase scheme. And why it's really interesting is, firstly, whilst they have a lot of professional experience, they don't have a huge amount of personal development experience, which makes it very difficult sometimes to transact. The schemes they've done previously are sort of 12 units, 14 units. So to jump up to 63 seems like a huge, and whilst they've worked on those kind of sites as a professional, they haven't done it personally. But why it was most interesting is what we've done is we've structured the finance in a way that meant, so the GDV of that site is just under 13 million, it's 12.8 million, I think. And the deposit they've had to put in is just over 900,000, which I know they're quite big numbers, but when you speak to most developers and you say, right, GDV scheme, 12.8, 63 units, how much deposit do you think you need? Most of them will think it's going to be sort of £2.5–3 million. So to be able to get into that scheme with just 900,000, and actually they borrowed half of that 900,000 from investors. So you got 3 shareholders who put in about 150,000 each. They borrowed 450,000 from investors, and then the rest is coming via a loan. And you think, I know 150,000 is still a lot of money, but most developers will have access to that kind of money. And so, to as they said quite eloquently, I felt, they said that basically their business plan, they'd move forward 5–10 years in their business plan just by coming onto the platform and being able to understand how to structure their finance.
Yeah, absolutely. And you've got to think, that 150k, obviously there was 3 of them, but that's giving them access to a 13 million pounds GDV site, which, let's just assume it was a 25% margin, for argument's sake. You're talking about a £3 million profit site, which they're getting access to for
450 grand.
Yeah, which is fantastic, isn't it? Well, let's hopefully impart some fantastic advice for everyone listening in today. I can see quite a few have now joined. We'll have a bit of a run through, like you say, we'll talk you through different ways of structuring those deals, and then obviously getting the finance to go with it as well. I think first up, we have a bit of a market overview from you, Ian.
Yeah, so this year's been a very good year, especially in comparison, obviously, to last year. Literally the market stopped lending almost entirely last year at certain points. So a lot of lenders have come into the market, or came into the market at the start of this year looking to be aggressive, and that's definitely been borne out. I think also what you're starting to see is it's a real buyer's market at the moment. If you have a good project and a good team around you, there's multiple opportunities. So as Andrew said at the start, don't take the first option or first lender you speak to. You can afford to shop around, because there's a lot of money out there chasing deals. There's been a lot of big European institutional funders and American institutional funders that have come into the market and made big statements about how much they want to lend. Obviously, we've got good state support with the current government. Whether how much longer there'll be the current government, I don't know. But obviously the whole COVID and Brexit, as any kind of big macro event, generally tends to lead to is infrastructure, is building and you know, trying to build yourself out of a slump, and obviously the current government are big proponents of that. So you know, I think a lot of these pan-European and American institutions are coming in knowing that the market is good for them. I've said there, third bullet, the market still is really difficult to navigate, which and again, getting finance and getting the right finance can be huge. Potential boom in PDR as surplus office stock. So I think here there's a stat saying 27 million square feet of office stock in the UK. Forecasts predict we will only need 60% to 80% of this post-pandemic. I don't know whether these figures have sort of been updated a bit since, because I think prior to yesterday, when everyone's been told to work from home again, the sort of general uptick in the commercial market space has been very strong. So whether I think 60% is probably a low number, whether it's more like sort of 70, 80, even 90% of pre-pandemic numbers, but that's still a huge amount of square footage that will be surplus. You know, I know with Nimbus especially, the platform's really well set up to identify those opportunities. So, you know, hopefully they come to the market in the near future. And as I said in the penultimate point there, you know, it's a great way for first-time developers to get into the market. You know, there's not really any lenders that will support first-time developers on new build projects. So, you know, to get in with PDR is a great way to get some experience under your belt.
Yeah, and just so that everyone's nice and clear, the PDR, permitted development rights, you know, so you're completely de-risking the planning by essentially, you know, it's the same planning process as, you know, building an extension on the back of your house, pretty much. You know, it's you know, you have those permitted development rights. You just got to go through that process with the council to do so. And like, yeah, as you mentioned, we'll actually have an example at the end, and I'll sort of, you know, we'll look for a sort of, well, maybe we'll look for an office scheme. I was going to say just look for a, you know, commercial conversion. So maybe, you know, specifically we'll look for an office one accordingly.
Well, yeah, commercial to resi. But I've said there on the last point, just remember that not all office stock is designed to be converted into resi. We've seen a few this year, which kind of you question the wisdom of the developer. You know, offices in industrial parks and next to bus depots and things like that. And yes, tenants probably are a bit more flexible on what they live in. So if you build to rent, there probably is a degree of flexibility, but you know, some of these things just can't be turned into resi stock.
I think, yeah, it just proves there's an element of due diligence with these, you know, and I think certainly with something like Nimbus Maps, we can help you find, you know, any office block, you know, really quickly, but there is an element of then saying, okay, you know, what is going to work and what can I make work as well, you know, and not just taking everything at face value.
Yeah.
Which I suppose, coming on to agreements then, so this is, you know, we'll sort of go through the sort of three ways, although I'll briefly mention all 5 of these, but I think there's sort of 3 which are more pertinent to developers on the webinar today. But ultimately, just so we're all on the same page, you know, I know there's a range in experience and abilities of people attracted to Nimbus Maps, but the different types of agreements, ultimately, they're all there to help you get into contract with a landowner, with a property owner to develop out their site. But ultimately, depending on the level of risk involved, depends on what kind of agreement you're going to go for, which ultimately then has a knock-on effect as to what kind of finance you're going to get as well. But very simply, unconditional contract is essentially what they'll all result into. The unconditional contract is the most straightforward. And then you have, depending on the sort of element of risk involved, a conditional contract where there's only a few bits that are conditional, joint ventures where then you will be sharing that risk, option agreements where then you can do all the work and still walk away, you know, if you don't get what you're after. And a promotion agreement is, is pretty much the same as an option. You're trying to get that planning, but you're on the landowner's side. And therefore you're looking to then sell that on to a developer and act on the landowner's side, maybe rather than on the developer's side. I suppose the key thing really is planning is generally that biggest risk with all of this, but you will have some of these conditions might be to do with ground surveys and all of that kind of stuff, but typically planning risk is the greatest one to be aware of. And ultimately, you don't really want to be getting into that unconditional contract unless it is you're taking on that risk yourself and you're very confident in getting planning. You want to try and get some form of conditionality, some form of option to cover off that planning risk, so that you only want to be absolutely committed to be buying that site once you've got planning. So that's just something to sort of bear in mind as we go through. So going into a bit more detail on some of those, and then basically Ian's going to follow up with a sort of example that relates to these type of agreements as well. The first one really is more of a both unconditional and conditional. I'm going to sort of treat the two together. I wasn't going to pick up on conditional, but I'll briefly mention it anyway. Obviously, unconditional, very straightforward. Once everything is agreed, it is just very quick to draft. And it's just very simple to say, look, you're going to be buying the piece of land or the piece of property at a particular price on a particular date, very much like buying a house. Therefore, very straightforward. The big, I guess, disadvantage, all your due diligence has to be done up front. So if you are, buying these rear gardens behind these sort of houses here to go and put in your sort of, 6-unit scheme, then you need to be confident in all of your costs, in the planning, all your surveys are done, everything you understand, and any sort of unforeseen costs have all been sort of specced out, and you have a really good understanding that, I am definitely going to develop this out for the price that we've agreed, and therefore that's the point at which to say, okay, yes, let's go for unconditional contract. That's an ideal world. I appreciate, maybe to be competitive with some other people, you might have to take an element of risk on a few bits. But the key things, I think, with an unconditional contract, the key tips to be aware of: avoid overage clawback clauses. If you've got a landowner who's a bit savvy, they might sort of push for this, or if they've got an agent on board, they might push for this as well. And certainly with a rising market, they'll push for saying, well, look, if you do better than what you've said, we want to get a share of that. Basically it's like sort of an anti-embarrassment clause for landowners. But bear in mind, you've got to think, yes, values are going up, but build costs are going up as well. So, there's lots of ways of pushing back against this to say, look, if you want that on overage on revenues, well, then I want clawback on my costs going up, and then they start getting a bit quieter at that point. So try your best to sort of avoid that and say, look, I'm giving you the best market value there is right now. I've still got to take all the build risk. And then if the values go up slightly since then, that might cover off any extra build cost that I've got as well. And then obviously, an exclusivity period is probably worth thinking about. If you are thinking, well, there's a few sort of bits that I'm a bit nervy about, and we need to go and take surveys, and they're going to take time to undertake. If it's going to drag on a little bit, just think about maybe an exclusivity period to say, look, let me bottom out these last few points, and then I will absolutely go into an unconditional contract. Or you could look at a conditional contract, which is essentially the same, but now there are 2 or 3, 1, 2, 3, 4, however many conditions that must be satisfied before you enter into that agreement. Those conditions could be, I will get planning. We will undertake a ground survey just to make sure that the conditions are as we expected and as we've assumed, because maybe the landowner hasn't done one in the first place, or there's a great big sewer across the site and you need to make inquiries as to whether it can be moved or whether you can actually build near it and all of that kind of stuff. So basically, if you've got something which is completely unknown, it's going to take a period of time to resolve, that's when you start looking at a conditional contract. But ultimately, you'll have obligations to address those conditions. You can't just say, okay, yeah, well, I'll do a survey and I'll do it in 12 months' time because I'm trying to sort out a few other deals and everything else. It's a case of trying to progress through, address those conditions as soon as possible, but obviously you'll agree a particular timescale, and then at that point it then becomes unconditional. So typically you would agree a price at this point. You know, with an unconditional contract, you would tend to say, look, it's £1 million subject to the ground condition, and then maybe the ground condition comes out and you say, well, look, you know, you can see here it's recommending foundations of 3 meters deep rather than 2 meters, and therefore it's going to cost me an extra 100 grand, you know, and then that's a bit of a negotiation. But ultimately the landowner knows they're pretty much bounded on a particular price. It does help you de-risk it though, which is great. However, just be mindful of that period to satisfy those conditions. There's, you know, landowners will say, well, okay, we'll go conditional on you getting planning, but, you know, we're giving you 3 months to go and get planning, or we're giving you 6 months to go and get planning. You know, they'll obviously push for you to be as tight as possible. They don't want you faffing around. They can't do anything else with that site. If you get cold feet and try and drag this out, they can't go to anyone else. So just to be mindful of those periods, and therefore one of those tips is maybe have extensions to those conditional periods. If you, I don't know, you go through planning and you get refused, you're going to go to appeal, then I would be then, you know, making sure you've got an extension clause in there that says if we do go to appeal, then the conditionality period extends accordingly, you know, a further 6 months, a further 12 months to allow you to run an appeal should you so wish. And again, we're same with this, very similar to the other one, avoid those overages and clawback clauses. But then we have a little example, haven't we, for
this is one I started with, yeah. I said 12.8 GDV, so there you go, 12.6. I was out a bit, yeah, this particular scheme. So this had outline planning, this scheme, which is again part of the reason why the equity input was lower, because there is an uplift in value between the outline planning and the detailed planning. So this wasn't a conditional purchase. They did purchase from the council actually, who'd done, I think probably, and Andrew might know a bit more on this, but probably what I'd term outline plus. So it was the highways agency had been consulted, the environmental agency, you know, the water board, etc. Everyone had been consulted on this development, and they had 63 white boxes on a sheet, which they then just had to decide the kind of makeup. So the reserve matters were relatively small for a site of this size, but what it meant was that you know, there was profit in the ground still, because they're not buying a site with detailed planning. It wasn't a huge uplift. It's going to be about sort of 500,000-600,000, the difference between buying with outline and the detailed, when you work back on the residual calculation, residual land value calculation. But what it meant is that the lender, so we purchased a site with a bridge. We're then working through the reserve matters. We've then split the title into two sections. So we're building out, I think, 32 phase 1, 31 phase 2. So what the lender does is they convert their bridge loan into a development loan on phase 1. We then take a bridge loan against the residual land value of phase 2. And then they build out phase 1, repay the loan of phase 1, and roll some of the equity into phase 2, and then build out phase 2. So in terms of an equity input, as I said at the start, it was just over 900,000. I think 925,000 or something like that was their deposit on this scheme, which again, as we said earlier, for something approaching nearly 13 million GDV, you know, for most people, most people would just pass on it and say, oh, that's too big, like I won't get the funding for that, or I haven't got enough money to get it off the ground. But you know, these guys actually didn't have a huge amount of personal experience. They'd done smaller schemes, much smaller schemes, less than 20. But by splitting it into phases, you're doing two things. Firstly, you're instead of it being 63 units, which on its own, most lenders probably wouldn't back them on, but 2 30-something unit schemes is actually much better for the lender, because I think their last scheme was 14 and they built 16 units. Now to go to 32 on phase one is actually a natural progression. So the lender then has the option of not funding phase two if it doesn't go to plan. They can still, but the borrower also has the option of selling phase two to somebody else and just taking the profit from the land. So by splitting the title and putting it into different phases, they've also they haven't got the risk of the sales like flooding the market with all of the same property at the same time. So they're actually minimizing their sales risk as well. So there's a lot of nice parts to it, but the best part about it, I think, is the fact that you can mobilize this scheme with less than £1 million of equity.
Yeah, yeah. And to be honest, that return on capital employed is phenomenal as well, to be honest.
Yeah.
That is very good. And I think the key thing here to sort of
especially over that term as well, 3 years.
Yeah,
I mean, normally over a 3-year period, anything over 50% would be very good, but to be still nearly 150 is phenomenal.
Yeah, I think that's up there. I think the best ever deal I've done, to be honest. I think, maybe we buy stuff on much smaller, rocky as I would call it, return on capital employed. But yeah. I think the key thing here, just to sort of link it back to those agreements, it's around that stage of the planning. So like you say, they're buying this site with outline planning, so that, like you said, that's where, if I can move back, here we go. That's where these agreements are sort of coming in place. If it had outline planning, you could either look at a conditional contract and say, okay, it's conditional upon getting those reserved matters. But by the sounds of it, with this scheme here, you're saying the outline covered a bit more than what you would expect. So typically it's always the principal and just the access. You would go for the outline, but it sounds like they've gone for almost the boxes are all going to be here, and here's the highways, and here's the open space and everything. And then you left it to just be, how big are the boxes and what shape are they going to be and all of that. And then so you're removing all that subjective design elements. But you could look at something like this, or you could have just said, and imagine probably in this case, they just said, look, it's an unconditional contract. We're pretty clear on what we're going to get on here. What boxes you can fit on that site. We know what we can pay for the site. So therefore, we'll give it an unconditional contract. And imagine if it was the council who was selling it, they'll probably just want an unconditional contract rather than having to be worrying about conditional contracts.
Yeah, absolutely. I mean, there's another project we've got going through at the moment with funding where the borrowers have entered into a conditional contract with the sellers. It has outline at the moment, and they're basically meeting the cost, the buyer that is, of getting it from outline to detailed. And then that's when they get to that stage, that's when their ability to, or their having to buy is triggered. So at that stage, they would have spent 40,000-50,000 of their own money as well. So they're still expecting a discount to market value, because whilst they haven't completed, they are putting some of their own money in at this stage. So it does mean, again, that they're probably getting a cheaper land deal than they would if it had gone to market with detailed planning. I think that's a real important part at the moment. At the moment, is that for the majority of land deals, sellers are looking for top dollar for their sites, and there are. I think there is a real dislocation between fair value and what people actually think they should get for their sites, the sellers. And so if you can get in at a slightly earlier stage than detailed planning, then I think it will always benefit the developer. There'll always be a bit of extra profit in that deal.
Yeah, and none of that, the things that from a developer point of view, you then dictate what boxes you're putting on there. That if you've just built a house and you had very few issues with it, and it sold well and it was really popular, then you want to be putting that same box on again and building that again to minimize your risks, building out the site. The last thing you want is to go, oh, I've now got to build this thing, which is all to weird dimensions, and and you're figuring it all out again. So yeah, definitely something to think about. So I think these are all on the basis that it's there with planning, or it's you know, with an option, or sorry, with an outline, or with detailed. You're going to look more at that sort of conditional / unconditional contract. Now taking a step further back again, where then, you know, there is no planning. You know, if we're looking at a particular field and thinking, great, you know, we want to go and build out a scheme on a field, we've now got to go and get planning. At that point, with a landowner, that's where then I'd be thinking a lot more around option agreements. You could get a subject to, but again, it's on that planning risk, you know. So, I mean, this particular site was a site that I worked on in my pre-Nimbus days. And because it wasn't allocated, we then went down the route of an option agreement, so that the planning risk was a bit greater. Therefore, we went down an option agreement. So the option agreement is very similar to the other one. It's basically saying, look, we want to have the option to buy the piece of land once we've satisfied the conditions. So it's a bit like a conditional contract, but then still giving you as the developer the ability to walk away if you don't quite get planning for what you expected. So, you know, with my old big PLC developer hat on, you know, obviously we wanted to get a certain minimum size of development on there. If the council said, look, we're happy for you to do it, but we only want 10 houses because it's fronting onto a lot of open space and we don't want to have a big dense development on the edge of the settlement, then obviously then we would say, well, look, you know what, we've got to walk away. We can't make this work for us as a company. We're gonna walk away. So it just completely de-risks the site for the developer, because you've got all the cards. You can dictate, you know, what you get planning for and whether you want to buy it, or maybe then at that point you could sell it on. I don't think we would ever walk away. We would always then try and sell it on to another developer. So, and the key thing here, because you're getting it at an earlier stage, like Ian mentioned, the earlier you can get in that sort of planning process, the more value, you know, the sort of planning uplift value you're going to get yourself, rather than all going to the landowner. And generally through an option agreement, you typically agree a discount of 10 to 20% based on the risk that you as the developer are going to take to go and get planning on that particular site. You're going to have to spend money on surveys, spend money on planning fees, spending money going back and forth to the council's website, maybe even looking at appeal, all to make that landowner rich with obviously huge uplift in the value of their land or property or whatever it may be. And so for that, you want to then have your discount to say, look, you know, there's my reward for getting this planning uplift, and that's typically that sort of 10 to 20% level. The advantages of this, obviously, I mean, one of the key ones for me, and certainly what was great doing this with my big PLC hat on, is it meant we were always agreeing the land value at the point we got planning. So when you satisfy those conditions and we said, look, we've now got planning, now let's try and agree that land value. It's difficult because then all that negotiation is happening then. At the same time, you're getting all excited about, great, when can I get started on site? And then you've got all these discussions going on about values. But if the market is going up or the market's going down, you're buying the site just before you're about to put a spade in the ground. So you're reducing that risk of buying it at one price and then the market doing something crazy in between. And now all of a sudden, maybe not then realizing the values that you assumed, you know, when you entered into the agreement. It does delay the purchase as well. So again, from a cash flow point of view and from a financing point of view, I mean, Ian, you can maybe provide a bit more on this, but I assume you're going to have to sort of find your own investors or self-fund that sort of initial planning stage. But then for the purchase, the beauty now is now you can then go and obviously seek some development finance because you have the planning. Now you're about to enter into this agreement to basically purchase the site, and then you can start straight away. So from a development finance point of view, you're reducing the time that you're going to have this finance. It's going to reduce those costs as well. And then disadvantages, like I say, because of, you know, I talk very you know, positively around option agreements from a developer's point of view. From a landowner's point of view, it's, you know, like I say, there's not a lot of certainty for them. You know, if you're sat there in the front room with a landowner saying, I want to get an option on their site, they're thinking, well, how much are you going to pay for my site? You say, well, we don't know yet. We don't know what we're going to get planning for. They'll be like, I'd rather you just try to work that out now and give me a price, and then I know, and then I can already start thinking about what holiday I'm going to go on and what, you know, car I'm going to buy and all of that kind of stuff. landowners just want the certainty, and this doesn't really give them any certainty up until the point where you do get planning. But you can argue that through with the risk, you know, like otherwise their options are they've got to go and take all that risk on themselves. They've got to go and then spend the money on the planning, which they don't want to do. They're a landowner, they're not, you know, a developer. So I think, you know, there are ways around it, but there's got to be a sufficient planning risk involved. I think if it's very clear that they're about to get planning and you just simply need to go through the process, then I think they've got an argument to say, look, you know, and by that I mean, you know, if it's allocated for a number of units or something like that, then it becomes more difficult to say we need an option agreement. And then typically tips for this: always takes longer than you think to get planning, so absolutely have the ability to extend the agreements. So typically you would say, I don't know, 5 years, you know, plus another 5 years, you know, if you elect to extend it. And that could be jointly, it could be unilaterally on the developer. You know, it's, you know, work with your development surveyor to solicitor to agree that. Careful with the valuation clause and the triggers around it. Obviously, once you get planning, you know, the trigger could be outline planning, or the trigger could be reserved matters. Makes a bit of a difference. You know, it could take another 6 months to get those reserved matters through, and all of a sudden you've been obliged to buy it, and you might not then realise we've got to build this whole scheme in Cotswold stone, which is going to be twice as much as that red brick that I was thinking of building it in. And the same with that valuation clause. You know, there's a lot of triggers around being able to take off costs, where does the discount come off, and all of this kind of stuff. So again, working with a good development surveyor will then help you make sure you get that valuation clause working for you as well. So like I said, that's the point, sort of going into getting planning and all that side of things. We've got a bit of an example of a sort of similar-ish sort of scheme here as well, haven't we?
Yeah, I mean, to go back to Andrew's point just on the previous slide, I mean, planning at the moment seems to be the bane of everyone's life. We're speaking to developers who have submitted planning applications, and having done them myself in the past, when, you know, pre-COVID, you'd normally get your notification or your acknowledgement within 2 to 3 days of submitting the application. And then from there is when the clock starts on the planning. And it's 8 to 12 weeks generally is kind of the accepted standards to have to come back to you in. We're speaking to developers that haven't had their acknowledgement, and they submitted their planning 4, 5, 6 months ago. So the clock doesn't start until they get that acknowledgement. So yeah, planning really is a killer on a lot of deals at the moment. So if you are buying something pre-detailed planning, so you know you're going to need to build in a longer funding into your cash flow. But as Andrew says here, if you've negotiated to purchase on an option, and it's conditional on planning, then you know you probably want to, whatever you think the longest amount of time you'll need is, double it and add a bit, because it just seems to be well, it's a bit of a perfect storm, isn't there? You know, councils all working from home, government relaxing planning rules, and you just got this mess really at the moment of applications.
There's a lack of staff, isn't there? Lack of investment in those planning departments, which is a false economy, because you know the planning departments always tend to, you know, be a net positive on the council in terms of fees and all of that. Kind of stuff. The developers are paying them lots of fees, but unfortunately it seems to be the one thing where they think, well, we could just have one person dealing with every planning application within the whole local authority or something. But you know, it's not quite that bad. But it's, yes, I'm hearing that a lot as well, that planning's become so bad that I think, like I say, more and more people are looking at that commercial to residential conversion, where there are limited development rights, and therefore you have got a much shorter, simpler planning process to go through that doesn't involve a lot of consultation and everything, where, you know, it's less resource on the council's time to be able to process them.
And the key with these option agreements or outline to detailed is you're adding sweat equity. So just to define that, sweat equity is the value you're adding by your own sort of graft rather than monetary input. I mean, there will be monetary input as well, but your sort of know-how, knowledge, expertise, and time is going into increasing the value of the site. So, you might purchase a site pre-planning for say 1 million, spend 200,000, and then it's worth 2 million. Most, not all lenders, but a good proportion of like the mainstream lenders will only lend a proportion of that 1.2 million. So the amount you've actually spent rather than the actual value, whereas other lenders will take a view on the value. So that's really important, because a bit similar to that first example I went through, there's 400, 500,000 of sweat equity between the outline and the detailed, and the lender is given the full benefit of that to the borrower. So that's £500,000 they didn't have to find themselves in hard equity, because the lender was happy to take a view on the soft/sweat equity. So, if you can add value at that stage, and your way around the lending market, it's going to dramatically reduce your own equity input.
Yeah, fantastic.
So this is an example where a borrower has negotiated a deferred land payment, and what that means is that the seller will take some of the payment at the end for the actual land, but the lender is happy to take a view on the full value of the land. Okay. So how does that help? So again, like I've just sort of talked about, is even though the exact numbers on this one escape me, I think they're paying 950 and the list price is 1.1, but the on completion, you're completing on 1.1 value, although you're only paying 950 for it. Most lenders, development lenders, and this is not something everyone knows, but they will have a cap on day one in terms of their value, loan to value. Some lenders don't have that cap at all, which is great for deals, especially in the permitted development space, because you tend to find that the costs of permitted development deals, the land cost is greater than the build cost, whereas on new builds you don't tend to see that. So this particular one, as a percentage of cost, the land cost is about 50% of all the costs. So some lenders, when they work out their loan, they will stop short of lending you a good amount against the land value, which means you have to put more equity in. So this is what was happening here. So the borrower then went back and negotiated this deferred land payment. So the lender is lending a percentage of 1.1 million, but because the borrower is only having to put in 950, they're only purchasing for 950 now, it means having to put in less equity up front. Most lenders are happy with the seller taking a second charge, so that 150,000 can be charged behind the senior lender, and as soon as the senior lender is paid off, then the landowner is paid their 150, and then the difference obviously is profit and retained by the developer. But it's quite a nice way of being able to put in less money into a scheme, and also giving the landowner comfort by allowing them to secure a second charge, rather than it just being an equitable or floating charge. They actually have a proper second charge, so they're a secure creditor against your site. So and I think we have this conversation with developers a lot, and I think most people, if they're selling land, they probably don't need all of the money, and they'll have something in mind, like they might want a nice car or another house or something like that, or going into another scheme. But the majority of them won't need all of that money. Some of it will be surplus. So just ask the question, say, look, how much you need today. I'm struggling to get to this number or make my finance work. But if you agree to take some at the end, then I can probably make it work. And you might find you actually pay slightly more for land. So in this example, rather than 1.1, you might offer to pay 1.15, but 200 of it at the end. But again, it's a way of getting into a deal with putting less in yourself, or paying less to investors, because a lot of developers will borrow from investors and pay profit shares away. Well, actually, if it can be all your own money going in up front, then there's less profit share there's less need to borrow from investors on a profit share basis.
Yeah, and I think, like I say, it's not something we've sort of mentioned before that, we've talked about the types of agreements, but obviously then you've got the terms within those agreements, and obviously a key element is that deferred payments. And I think I've sort of summarized it as one of the sort of key tips at the end around just minimizing, you want to be minimizing the cash that you have to spend, but then also think about it in cash flow terms as well. So even if it is the same, but you can spread it out over a much longer period, and then obviously then you're not that's peak in funding that you need to cover off that biggest expense, hopefully then gets spread out over a much longer term. And you've got to think that obviously these 16 apartments, they'll start then selling some of those off, so if you can structure that deal to say sell off the first 3 houses, and that starts funding the rest of the development, a bit like on the first example, then again minimizing the finance that you're having to take, and then hopefully improving the returns that you make on that particular site.
Cash is king.
Well, indeed. So the final one, so I wasn't going to go through, it was the JV, sorry, was the one I wasn't going to go through, but I'll mention briefly. The final one is a promotion agreement, which is very similar to an option agreement, but this is then where you're looking to develop out and get planning for the landowner, and then you act with the landowner and go and sell it to a developer. So you're basically saying, look, so it's like I say, it's very similar terms. You're basically saying, okay, look, I'm going to promote this site through planning. I'm going to be putting all that risk in to get this site through planning. There's no guarantee, but that's the risk I'm going to take on. And therefore, when I do sell it, I typically want to then get that 20% return back as a reward for the risk that I took and the time and everything that I've put into this over the years to get planning. The great thing with this is you're very aligned with the landowner and the property owner. So you're basically saying, look, bring me on board. I'm an expert at getting planning. I'm an expert who knows all the developers in the area and can maximize the value that you're going to get as the landowner, because I can extract all that out of the developers. I'm going to get lots of them all bidding over this site, and we're going to make a lot of money for it. I just need to go and get planning first. So from a landowner point of view, they think, fantastic, I've got my little expert on board who's going to go and get the planning for this particular site. The disadvantage is you do then need to be able to then know where you can find those developers, obviously manage that sale through with them as well. I mean, at this point, you probably could get an agent on board if you're a bit unsure about that. But ultimately, then you need to be able to get planning for what developers want as well. So there's no point getting planning for a load of apartments in a rural village that no developer wants to develop out, because they're only going to go in for planning and try and rechange it and therefore not give you a high value. You've got to have a good understanding of what that market need is, and therefore get planning for something along those lines. Or maybe you just want to stick to outline, again, not quite maximizing all of the value there, but getting most of the uplift in value. Stick to that outline, allow the developer to come in and go, right, we'll put our own boxes on, and we'll decide where that goes. Tip to this one, make sure you're getting all your costs back through that sale. So the 20% is really should be the 20% reward to you. You should then have to then cover off all your costs in that as well. So you want to get 20% and you want to get your 100 grand of costs back as well. And then whether planning permission is satisfactory should be your decision. And this also applies to sort of option agreements as well. The last thing you want is you get one planning application. Maybe you had to sort of compromise to get through the planning process and just get a permission to get that principle established. You might be thinking, well, hold on a minute, I know I can go back in and I can get more over here. The last thing you want is the landowner going, fantastic, I'm happy with this, let's move on, because you're leaving value on the table then. So you want to be a bit more in control of when that planning permission is satisfactory, rather than just leaving it to the landowner. And then the final permitted development, I guess, yeah, we never put in we'll go through a permitted development example live through the platform as well, rather than as a contract sort of example. But I suppose, Ian, you want to talk us through this particular
Yeah, so this was a first-time developer. A lady actually had expertise, or she was a construction professional. She's actually an interior designer, so used to working in construction. First scheme that she'd ever done herself. Had acquired the site, kind of pieced it together. There was a bit of a land assembly, 2 or 3 sites. I think what was really horrible for her, but like was really good for us, I think, is that she'd actually gone and spoken to, I think, 7 lenders to get funding, and every single one of them had declined for different reasons. You know, one, experience, the personal guarantee that she could provide wasn't up to the level that the lender needed, and really what it needed was just good presentation, but also, as we highlighted at the top, that sort of tendering process that we go through on the platform. You know, you put all the information on there, you kind of get it all out there in the open, and you just ask lenders to come in and view, and you know, you will kind of get that competitive nature, and lenders will bid, we find, more than if perhaps they were approached you know, on a one-off basis. So yeah, we got a very good deal for this lady. She's very happy. She had a bridge on the site already. She'd added some value through the planning process, and she didn't have to put any more money in, which was key. But then she was just amazed, really, that she'd spent, I think it was almost a year trying to get funding, you know, she'd had certain lenders like really lead her along and take months to get to a slow no. And she came onto the platform, we put all the information on, and she got heads of terms from one lender within about 2.5 hours. And that was actually the lender. There was a few other lenders quoted, but it was actually that first lender that we ended up completing the loan with.
Wow. And I think, well, and I think the great thing with that is, you know, that first time developer as well. So, you know, like I say, this isn't something which you've sort of got to wait until you've done 2 or 3 schemes. You know, it is possible, you know, obviously a relative size, you know, you can't, like you say, go off and do your big 100-unit scheme first off.
Sure, yeah. I mean, this is a good scheme. There was it was just a heavy refurb, really. I mean, it was just, there were big sort of warehouse style offices, and they were all stripped out, so it was just 2 floors, and all that needed to go in was the dividing walls for each apartment. Yeah, I mean, the replacement of windows, that kind of thing, but it really was like a perfect first scheme for someone, you know, that obviously has some kind of experience. But she had a really good project manager. I think the key really is, if you're going into a first-time development, if you're a first-time developer, the people around you are what the lender's going to be concentrating on. So, you know, having people that are overqualified. Through her work connections, she had a project manager that, you know, was used to working on much bigger schemes, and he'd been drafted in to work on this. The contractor was used to building bigger schemes as well. So she may have paid a bit more for that expertise around her, but, you know, it meant she got the lending, but also she probably meant she could sleep better at night. So, you know, yeah, it's worth paying a little bit extra, certainly for the first couple of deals, just to because you're going to learn loads. So having good people around you is imperative.
Yeah, vital. Absolutely. Right, I'm conscious of time. So the final one, which I'll sort of very briefly, so this isn't sort of one of the top 3, but joint venture, they're really difficult, to be honest, to get right. I've never managed to actually, you know, formally on the land. I know a lot of at that sort of SME level, people will partner up with each other, but you're pretty much on the same side, and you're going in sort of 50-50. But to really make this work from a sort of landowner / developer point of view, they're quite tricky. So the key thing is, obviously it does share the risk, so it's great. Like I think it was Ian's first example with the 3 developers each putting in their own money. Then obviously you're sharing that risk, but then sharing the upside. So then you've got to be really careful around what that revenue sharing mechanism is, getting those costs back, especially if you've got a landowner. Are they just putting the land in? They need all their money for their land back whilst then sharing profits. You know, I'm not trying to put anyone off, but it, you know, you've got to really think about you know, how all these mechanisms work. So you need a very good solicitor who can help, you know, sort of draft all this as well, and being very clear on their responsibilities. You know, is someone responsible for all the build? Is someone responsible for, you know, for building one side and the other and all of that kind of stuff? So again, just being really clear who's doing what, who's reporting to who, how is all the money getting split down? Is there a third party who's going to manage that? You know, so there's a lot to think about. And the key things are really, yeah, just know who you're partnering with very well first and have a lot of trust in them, because obviously if it goes wrong, you then got a whole load of issues around how you start unpicking this agreement, potentially getting someone else to step in place, and ultimately you are probably going to lose out if one party does walk away, just by trying to get it all wrapped back up again. But that's just another way to think about. But I suppose how to approach funders, I guess, as a sort of summary slide before we get into a bit of a worked example and open it up to a Q&A.
I think just be prepared. You know, there's so much information out there that the lender will find out. So, you know, be honest. If you've got skeletons in your closet, you know, get them out there. Because most lenders with developers, they tend to be a lot more flexible. It's more about the asset than whether you've got a CCJ or a missed like credit card payment. That becomes a bit more of an irrelevance, unlike a regular mortgage. But you know, they want to know that they're dealing with organised people that can mitigate risk. And I think you know, we tend to see people coming into development perhaps from risk management backgrounds, and they tend to sort of transfer really well. So, you know, accountants, management consultants, people perhaps that have worked in finance, and you know, and then obviously all the trades as well. So people that can build and project manage it and things like that. But you know, you need to demonstrate that you thought of everything. You know, what happens if you can't sell? What happens if your build costs jump by 10, 15%? What happens if you can't get the labour? What happens if your project manager gets run over by a bus? What happens if COVID happens? You know, these are all the things that you need to think about, because ultimately you need to think of the lender as a partner, right? You both want the same outcome, which is to build the thing, pay back the lender and have some profit at the end. You know, the lender wants you to profit as much as they want their money back. So, you know, do show that you've thought about all the risks and how you're going to mitigate it. Yeah, then know your partners and suppliers. So, you know, you're with a contractor, with you know, a project manager, unless you've worked with them before, you kind of you're putting a lot of trust into these people. You are going to be asked to provide a personal guarantee on the loan to the lender. So you're going to need, you know, that your personal guarantee really hinges on their ability to perform to their contract. So make sure you know them, you've checked their accounts, you've spoken to previous customers. That's really the best way to do it. And going back to Andrew's point just a second ago, said using a good construction lawyer on the JV, I'd say that goes across the board. You know, definitely use a specialist in construction when you're doing anything in development. I mean, we sometimes come across people that are trying to use regular conveyancers who've said they can do construction and they can't. You know, we get to the legal stage and the lender's lawyers sort of pulling their hair out, and we end up telling sometimes the solicitor what they need to do. It's a bit embarrassing.
Yeah.
But do, you know, pay for good advice, especially if you're going into this, you know, early on in your development career, because you know you will come unstuck if, you know, if your construction lawyer, especially on the contract with your main contractor, if you haven't thought through that properly, then you know, when things go wrong, which hopefully it never does, but when it does, then it will go spectacularly well.
Yeah, and funny enough, you know, my tips around, you know, from the
there we go,
developer point of view, number one is literally, yeah, use a good development surveyor. You know, I know, you know, that first time round you're thinking, oh, I don't really want to pay those sort of fees for a top end, but I you know, I cannot tell you the amount of times where, we've been saved by a particular clause in the contract, or we've been, when we come to the valuation, having someone sort of talk through and argue through that, no, this is the way that we apply the calculation within the contract, and and actually it works out in our favor rather than in a different way. It becomes so key and can really make the value back in no time. And like you say, when you look at those profit figures, when you're doing this personally for yourself, being able to take a small hit on those is perfectly reasonable. Like you say, in a big PLC, then we just need to hit those margin figures. And obviously we've got access to very good national solicitors anyway, who are doing that stuff day in, day out. And again, a bit like, following on from what Ian was saying, from a developer, it's just good practice. The last thing you want, regardless of whether you've got a lender on your back or you've got it all self-funded, you need to understand all of the risks involved. And when I say risks, it's sort of like I say, what are those land values? What are those sales values? What's the planning risk? What's going on all around it? But obviously, what's all the costs involved? It's not just building the houses. You should get pretty comfortable around how much it's going to cost to build that house. It's what's in the ground. It's the roads. It's the services. How are you getting all of those to site? Have you definitely you've got complete clarity on how that's all going to happen, and it's all been costed and it's all in there? Because the last thing you want to do is then get up on site and then sort of go, oh shit, we didn't actually realize the water was half a mile away and it's going to cost £500,000 to get it to here, or whatever, or it's going to cost whatever, because all that's going to do is come out of your own profit. That's the first place it comes from, because like you say, your lender's got their clause in you, so they're going to get their money back, and likewise, if you've got investors, then obviously it's going to go to them first before it comes back to you. And again, thinking about cash flow, like I said, when we talked about deferring land payments, delaying Section 106 payments, all of that kind of stuff, looking at, and again with a development appraisal, trying to think about, when am I going to be spending all of these costs, and trying to sort of see if you can spread those out as much as possible or delay them to the end of the development. Because if you can do so, and for those of you who are doing schemes with affordable housing providers, we've got a webinar next week all about affordable housing and how to really maximize that, because ultimately they'll give you money up front for the land and for for putting the foundations in for the affordable housing units, which is then going to help you fund the rest of your development. So yes, it has another layer of complexity, another partner involved, but what it does mean is you have to spend less money up front, and therefore does that reduce the amount of funding you need to be able to develop out that site. So again, just really thinking that cash flow is really important, even on the smaller schemes as well as the larger schemes. Right, I'm conscious of time. How does Nimbus helps? Let's bring this to life with a bit of an example. If someone wants to sort of put in the chat and or the Q&A a location, we'll use that. We'll have a very quick look. We said we're going to look for an office to Resi. Oh, right. Thank you, everyone. So we've got Reading, Leamington, and Manchester. Let's start off with Reading. I was going to say, I'm going to try and be Paul and say, put me on the clock, Ian, and all of that. But, I've got complete faith in being able to find one very quickly. So again, just to sort of work through, what are we going to be sort of paying for these kind of sites, and therefore the kind of sort of funding involved and how that's going to work with Brickflow. We've got all that integrated into the platform now as well. So we're in Reading. We're looking for, a commercial to residential. So it could be a Class MA, or it could be Class G, and ultimately, in Nimbus, it's super easy to find them, because simply we can toggle those on and we can go and look up those particular buildings, which we've got a nice, what looks like a nice juicy one here, which looks like a sort of car garage, Class E use. We can see the breakdown. We did say an office to Resi one, didn't we? So clearly I've sort of broke on this, and it is a little workshop type thing. Same thing applies. You can see from this indicative appraisal, we're talking about a 100% return on cost. Not too bad. That one doesn't look very officey either. But I did see another one over this way. What's going on over here? These are offices. There we go. Fantastic. So an office scheme here. Again, we can look up the details. That seems to be all over there with a bit of parking. And we can see here through this breakdown that we've got ground floor office, first floor office. So it's not a huge scheme. So you're talking, you know, there's, you know, just under 1,000 square feet with another sort of 1,000 square feet, or maybe a bit bigger with sort of the internal storage and everything sort of brought into it as well. But sort of 2,000 square feet would make for, I don't know, sort of 4 apartments or something. Maybe you'd sort of squeeze into there, you know, maybe with a building something in the roof. It looks like there's sort of dormers and things in the roof as well. But by that, you can see how this appraisal works. So we're trying to get you as far in advance as we can through that due diligence. So we know here by the fact that it's highlighted, we know it meets the criteria for Class E to residential. So that's what's called Class MA, is the permitted development right. Then we undertake an appraisal on this particular scheme. So we can see here it's just over 2,000 square feet. The rateable value that they're paying for this particular building, we can see here, obviously most of the value tends to be in these 2 office bits here, but we're just going to convert the whole building. But they're paying on average, you know, just under £7 a square foot. Therefore, if we sort of say, look, well, what's their rent? You know, their rent, you know, that rateable value is from 2015, which was hopefully set at what their rent was. There's been some inflation, so now we're at sort of getting to £9.5 a square foot. We're assuming a 7% net initial yield based on what yields are typically in this part of the country. So now we're looking at somewhere in and around £130 a square foot for the purchase price of that particular building based on its existing use value. Therefore, this is the price we'd be looking obviously to purchase the site. Then obviously you'd have any sort of planning cost to bear in mind as well. But ultimately factoring that in, there's your GDV. We're assuming £440 a square foot because the average in the area is 360. Therefore, once you inflate that up for new build, brand new apartments, you're going to get something more like 440. Working all that appraisal through, we think you could make 450,000 profit on this particular scheme. Obviously, we haven't factored in sort of bill costs, sort of finance costs and everything in like that. But what this is more about doing is just sort of saying, look, it is an opportunity. It now requires sort of further due diligence. And some of that due diligence can be, let's check some of the constraints, which through this location analysis, we can look at obviously any technical constraints that are there. But a lot of them that you're going to be probably focused in on are under this planning policy section. Things like, you know, is there any flooding which is going through here? And it looks like there isn't. There's a little bit over there. We can see where that flooding is, but also, is it listed? Is it in a conservation area? Which it is in a conservation area. Come on, my computer seems to have slowed down that we're on Zoom. It is in a conservation area. So again, that's going to be potentially an impact study and just something to be aware of. But again, we can show you how to find planning applications to see whether there's anything else that's been happened in this area. And everything around it seems to be listed, but this isn't. So then again, just is that going to have an impact? We can click on these surrounding properties, find out why it was listed. Is it because it's a fantastically looking building and therefore we want to, you've got to protect the views on it and all of that kind of stuff. You can then start factoring that into your application as well. But if we have a look here, we can see here, Daniel Owing Building Recruitment Solutions is the office that is impacted. Actually, no, is it more this building here? It looks like it's this building here actually, which is quite nice and looks like it is.
Nice looking building.
Yeah. I was going to say that's better than the one next door. Although the one next door is 100% as well. So clearly both of them are an opportunity. So there's 2 letters we want to be sending out. But we can see here, this is why they're all listed. They've all got this fancy frontage to these buildings. And so, it certainly looks like, yes, from this level, you can see why it's listed. But from here, it's just the back of a lot of old houses. So, I wouldn't be surprised to get any sort of, or get any difficulty with those. And certainly with this as well. And the beauty is we do have a bit of parking. If we were to convert that to, looks like you could get 4 spaces in there. So then there's your four apartments, 4 spaces. That works quite nicely.
It's even a bin store there already, by looks things.
Well, yeah, I was going to say it's just crying out for it. But I suppose that is it with offices, really, isn't it? You know, they're already there. You know, they've already got probably, you know, sort of biggish rooms that can then just be nicely subdivided into areas. The other key elements in here are then obviously what are those values likely to be? We've got the new residential comparables, which just allows us to toggle those on. And now we can see what pound per square foot are in the area. So again, trying to back up that 440 that was assumed in the little mini appraisal here. We're seeing 440. Well, now we can have a look and we can see, you know, 345, there's 600 there. So that's obviously quite a key one, but there's 450. So there is certainly some which are coming out for 400, 418. So certainly in and around this area, it doesn't seem so ridiculous to be getting 430. Obviously what we can do is if we reduce this down, so it's 346 is the average for everything that's on the screen, but you can split out the and break this down. So we could say, well, look, we know it's going to be flats, so then we can then reduce this down and only then highlight all of the flatted properties and then sort of see what's coming out with that. We might want to then look across 18 months. Obviously leasehold, you know, we might want to then have a look into as well. And so now we can really narrow down those comparables so that when you're going to that lender and you're saying, look, I'm going to get £440 a square foot across all of the 4 flats, which I think was working out, I think it was about 900,000 in the end, wasn't it? 960,000. So, you know, 960 divided by the 4, so 240,000 a flat. Again, obviously we're in pound per square foot. We could switch to this. Now we can see, you know, are we going to get 240 for each of these flats? I have to say, headline, it looks like we might struggle. It looks more like sort of 205, 230, 225, 235. So it's starting to push it. You know, one of the things we can do is then we can index those prices, which is then going to bring all of the prices from when they sold and bring them up to today's prices based on the change in property prices in this area. We get that information from the land registry. They tell us how much each area has moved up and we can apply that accordingly. And you can see here, other than this one at 320, 240 a flat, it's pushing it a little bit. There's going to have to be some really standout apartments if you're going to get 240 or a really high spec. But again, you know, we can put all of that information to Excel. Or if you want to find out, well, how did this one get 225? You have got the find particulars button here as well to take you through to Rightmove. We'll just show you that, how that link works. But there you go, through to Rightmove. Click on the appropriate property to get, you know, the details and sort of see why that one achieved that kind of value. You know, like 246. And rather than look at that one. But now you can pull all this information together, so you can sit armed with all these examples. So when you're talking to that lender, you can then obviously see how that works and say, look, I'm definitely going to get my 240. Here's example 1, 2, 3, 4. They all sold recently. They're all exactly the same as what I'm talking about, and they're all within, you know, 500 meters or so of the property. So, like I say, I'm being very quick, so I want to open it up to a Q&A. Then I think the key thing here is we sort of say, okay, we're definitely interested in this particular one here. The one thing we want to be doing is then making sure we've saved the details, which we do by, so if you've got the little box here, click the title number, brings up this information panel, add to workflow. I'm going to be saving this as an opportunity. All this is completely customizable, but I'm going to say that this is a Class MA version. Whoops. Save. I've now got a pin on that save now. So if I do want to buy the title, I can either do that here or through the workflow section. You can then buy lots of different titles. You can download all this information into an Excel file. You can write hundreds of letters off to these owners, all through the workflow system. Again, I'm going to save that, have a demonstration with the team if you want to find out more about how to do that. But like I say, you've got the property, we've got it saved. Can we go get some finance on it? So now if we scroll down onto the information panel, you'll see this link here, which will take you through to Brickflow and straight into, and this is probably where, you know, I can hand over to you, Ian, in terms of how all this works, but ultimately you'll be able to then plug in all the details and it will then
do you want to put numbers in?
Yeah, why not then? So
285 was roughly what it was predicting.
So 285.
Purchase costs are going to be what, 10 grand, 15 grand?
Yeah.
So if you click example, it'll tell you what we want in there. Yeah. Okay, yeah, so 15 grand. Property location, southeast.
Yeah, let's have a look. Southeast.
New build.
Well, it was a conversion, wasn't it?
Oh, sorry, yeah, conversion, yeah.
Committed development as well.
Yeah.
Or we could select more. So then end property. We're looking
residential.
Residential.
4 flats. 4. Yeah. And then build costs, it projected 220,000 roughly.
220.
Gross internal area was 2,200
square.
Yeah, and then professional costs and charges. So if you click example again, Andrew, so it tells you all the other things that we want in that box. So if you put in, I don't know, 50,000.
Yeah, I was going to say, a bit of planning fees and surveys and all of that kind of stuff will all be in there.
Yeah.
So now we've got our talk.
Next. And then GDV, well, we say about 900, I think, 225 a flat.
That's fine, 900.
Probably do it in 9 months.
Yeah, 9.
Maybe less. Maybe change that to 15.
15.
And then sales, fine.
Yeah, we're going to sell it at the end.
Yeah. And if you just accept the cookies at the top, oh, yeah. Put your details in.
I'm a developer. I've read the terms and conditions.
Yeah. Okay. So if you scroll down, so these are your loan options.
So we can see here.
So deposit on that top one, 66,000.
Yeah. Okay. Yeah. So basically, this is talking through the scheme. We'd be looking at putting in 66,000 ourselves, and then that profit figure was obviously a bit lower now that it's factored in a bit of finance cost, but making 233,000, which then gives you that return on capital employed of close to 300%. So
if you hit check eligibility on that one there, this is to tell you a bit more about the lender. So deposit, they will consider 100% of total deposit from investors. They'll consider charges over other property instead of cash. Will you lend to a first-time developer? Yes.
Yeah. Bit of development rights, which is obviously what
they're happy. Yeah. Won't do air rights, won't do listed, modular, they're happy with. So you get a really good feel then for what the lender's up to. So what you do, if you just scroll down, add that to your shortlist. And then you can add up to 5 to your shortlist. So you could, add a few, hit proceed. And this is where the sort of auction tendering bit goes on. So what you do now is you work through each of these modules. So you put some information in about yourself, your appraisal. So the appraisal, if you click into it, development appraisal, is pulled through all the information from the search. So all you need to do is put the address in at the top. If you go across the tabs there, Andy, at the top, build cost, borrowing. Yeah. You can break down the cost further if you want. If you flick that to yes in the middle. Yeah, you can break that down further, or you can just keep it as one lump sum, whatever you prefer.
As I say, do you think this is going to help in terms of giving that confidence to developers and to the?
Absolutely, I think if you go to that effort, lenders will will definitely prefer it. But certainly for initial stages, if you just want to keep it quite high level, then you can. So you put any of your marketing costs, etc. in there.
Yeah. You're building for, yeah. And
then if you hit dashboard or finish. And then development schedule. So you've got your 4 units, you just put in the details of each unit.
Yeah.
And then dashboard again. If you roll down a bit further, so these are optional. If you want to add in details of your professional team, your comps, you can add in there. And then if you roll down a bit further, there's some optional documents that, you know, if you want to add, get you a better result. And then once you're happy, you submit to us to review it, and then a human being reviews it. And then it gets submitted. Once we're happy, we submit it to lenders, and those 3 lenders you selected on the previous screen will get a message saying, you know, new opportunity from Brickflow, please submit your best bid.
Fantastic. Like I say, it just makes it so easy now. So like I say, you've gone from finding it to then getting a whole load of offers back in terms of
hit results. You go back to the results screen.
You know, and then like I say, you're going to get a whole load of offers back to give you the finance to go and do that, which then means if you are sat down having a cup of tea with this particular property owner, which is Marine Ventures Holdings, actually still based in Reading as well, then obviously, you know, and they say, well, have you got the finance to do it? Then, you know, you're going to be able to stand by and say, well, yes, I'm currently getting contacted by three lenders right now who are then going to basically go through. And
if you roll down it, I mean, there'll be 20 odd options there.
Yeah, I was going to say, yeah, there's loads here.
There's a lot of options. You'll probably find,
like you say, require a lot more of a deposit.
Exactly, deposit gets, so we rank in order of smallest loan first.
But yeah,
smallest deposit first. Sorry, largest loan first. That's what I meant to say.
But you can then see all the fees here and stuff as well. So, like I say, it's making it super simple now to go from finding that site, getting your funding, and making it happen, and hopefully removing as many steps in that journey as possible. And like I say, so the button is just there. Like I say, whenever you click on a property, if you're thinking, great, you know, what was that site again? It's right here. It's Brickflow. Simply click on the link. It'll take you through to that.
But that's the beauty of it. You've condensed there what's something that should take, you know, months to find the site and find the finance into 10 minutes. You know.
Yeah. I mean, literally, you could, you know, I mean, we could write a letter, and by the time that they've come back and we've actually sat and had a cup of tea with that property owner, we've had the deals come back from the lenders. You know, we're sat there going, I know I've got my finance, I've now got my, you know, my deal. Obviously, you've got to negotiate that deal. You know, you could be cracking, and this is what it's all about, getting that 2022 going with your sites. So, conscious of time, we really don't have much time left. But for those of you who want to find out more about Brickflow, like I say, the information's there. You know, that takes you through to their website. So if you do want to go through, obviously, you know, you can go back to their homepage. You can look up all about everything you guys are doing, aren't you, Ian? It's all on there.
Yep.
And like I say, you've got the link directly within Nimbus as well to help you find that, to find the properties in the first place, depending on what it is you're looking for. Commercial conversions, residential land and airspace, and HMOs are 3 different strategies. So if you're looking for commercial conversions, we'll give you all of the tools to help you find those properties, just like what I used here. That's what these are. But then if you're looking for absolute just land, then we've got strategies to do that as well. If you do want to find out more and have a full demonstration, because I fully accept I just went through super quickly and obviously with one example. If you do want to have a full run through, definitely click on the link. I've just put it in the chat. That will get you a call with one of the team. They'll give you a full demonstration and give you a bit of a trial of the platform as well, so you can see how it works for you. And ultimately, let's try and answer a few questions. I'm conscious we don't have loads of time, and I know want to respect everyone's time, so we'll try and whiz through as many as I can. Starting with the Q&A section, Daniel A has asked, hey guys, how much extra per month for the commercial to resi add-on? It is, if I can check my notes, you're looking at going from around about an extra £100. But obviously, if you've got the existing package, speak to the team. They can then talk about a specific upgrade price specifically for the Elite Plus strategies. That's for you, Daniel. So if you click the link, the guys will give you a call and they'll talk you through. You know, even if you've got an account, they'll talk you through it. Dominic, would you discourage people from looking at Class MA in a conservation area due to the impact assessment or possibly delay refusal on the PD? I wouldn't necessarily discourage it. I just think you've just got to bear that in mind. I think
that's Class MA in conservation.
Yeah.
Didn't that just change? Wasn't that one of the rules that changed in August, where there's no longer a problem?
Yeah, you can still do it in a Class MA, sorry, in a conservation area. Conservation. Let me just see. There's nothing about conservation area. So you cannot use it in these. Yeah, so there's no impact on conservation area.
I think in August it changed. I think conservation areas were taken out. So I don't think it impacts now, but speak to somebody more knowledgeable than me.
Yeah, yeah. And but I think, you know, yes, it just gives another bit of ammunition to the council. So for me, I would just, yes, we make it so easy for you to find lots of opportunities that I would just try them all, and ultimately, you know, to be honest, at the point at which you get someone, it's difficult enough to get an agreement with someone to acquire their property or their piece of land or whatever it is, that if it happens to be in a conservation area and that's the only one that you can make work, then obviously work it through with the council and talk them through with it. It depends why, you know, this is obviously looks like a conservation area because a lot of the buildings on Castle Hill, and it's obviously just trying to protect the buildings around it. Just gives the council a bit more control of what can and can't happen. So I wouldn't necessarily discourage it. I would prioritize other properties over that one if I had the options, you know. Is that sold property price indexing built into Nimbus Maps, or is there a new build button to click? There's a bit of both with the comparables, Dominic. So you know, once you're setting these, you can obviously look at commercial pricing as well. But if you're looking at this, you can say, well, look, I only want to see new build ones, or I want to see all of them. The only issue is with something like this, if you say a new build, then yes, it might pick up this sort of block of apartments here or something that might be actually retirement or something. There isn't huge amounts of new build going on. Obviously, if you're on maybe the edge of town where, you know, I don't know where people are building in Reading, but I imagine probably on the, you know, on the outskirts, there'll be bits of development going on. So if you were going to be building something in Shinfield and converting a commercial property here, then you may say, well, okay, like what are the new build values that are getting, because there's some development going on over here. There's a whole lot of development going on down here as well. So you're going to get some really good new build comparables, but you can select it however you like. The separate one around the indexing is more here. You can just have it indexed up to current values or the sold price at the date at which it's sold. Nadeem, I have a couple of deals I'm working on. How do I engage Ian to see if they stack up on finance? I suppose that's going through your website, Ian, or
yeah, do a search, Nadeem. I'll put my email address in here, but yeah, if you do a search, I mean, hopefully you saw just a second ago how easy it was when Andrew ran it through. So do a search, and either myself or one of the team will get notification, and we'll be straight into contact to discuss it with you.
Fantastic. That was for Nadeem. Does a smaller deposit attract higher interest rate for lenders? Well, what I would suggest, Nadeem, in the fullest of time, is put your details in, and you can actually compare those options on the site. I don't know whether we can get back now to.
Yeah, generally yes, Nadeem is kind of the answer. Not always. I mean, as you'll see there, so 8.4% is the interest rate on that top option. 10.8 is the next. 9 is the next. But I think this is the key that most people don't understand, is that every lender calculates differently. So it's not always the case that you're going to get more, the biggest loan is going to be the most expensive. Most of the times it is, but not always. So just depends on how the numbers work. There's so many variables that go into calculating development finance. It's not quite as simple as saying, yes, that would always be the case.
Fantastic. Celeste asked, at what stage does it make sense to go into auction for lenders in terms of engagement with the property owner? I suppose there's no harm at any stage, I suppose. I guess you're not going to be paying off lenders if you're constantly asking for pricing, or I guess is there a point at which, Ian, you're saying, actually it'd be good to know that you're in discussions with someone rather than just arbitrarily.
Yeah, I mean, it's one of these things that, I mean, there's a certain amount of information you have to put onto the platform. So, if you've just seen a site on Rightmove and you just plugging it into the search engine, that's fine. I mean, that's the point, is this comparison part that Andrew's just gone through. That's how people tend to use it, is that they might have 10 sites they're looking at. They run them all through here and realize actually 8 of them aren't viable because they don't have the money to mobilize. So then they just concentrate on the 2 that are. Normally, I would say, in terms of getting the heads of the kind of auction, the heads of terms, which is where lenders are confirming that they'll lend to you. If you're newer to development and therefore you're worried about your level of experience and how lenders might view that, then I would suggest going through that process earlier. So have a site in mind, because you can't just put dummy details in. There needs to be enough information about a particular site for the lender to be able to give you definitive terms. But if you're worried about, as I say, your level of experience or the people around you, then it's a really good way of finding out what lender's appetite is for you, because all of these options on screen here are assuming a certain amount of experience. So some lenders will lend first-time developers, others won't, and others will only if you have the right people around you. So it's a really good way to get feedback from lenders to understand what they want to see from you. But normally what we find is most people, when they've they've made an offer, or they're looking to make an offer, that's when most people go through the process, or the offer's been accepted. I certainly wouldn't be trying to get terms agreed every time you're interested in the site, because it's a bit of a waste of your time and the lenders. I'd certainly get to a bit more definite before you go through that process.
But you can get to this stage that we've gone through here.
Correct. Yeah, absolutely. But the auction part, which is where you're asking lenders to bid, you kind of want to be a bit more certain, I think, because lenders will just get a bit annoyed if you're sending them 20 deals a week and none of them are happening. They'll get a bit frustrated with us as well.
But like you say, you can get to this stage, you can already get a really good understanding as to what kind of funding you could get, the kind of deposits involved, and therefore really run your numbers in detail before then saying, yeah, absolutely, we can make this deal work. I'm going to instruct solicitors, all of that kind of stuff. You're already at that stage where you can make it work. So hopefully that answers your question. And finally, Ian, can you recommend other parts of the country for Class MA apart from the Southeast? Do not fear, Ian. There is, Class MA opportunities across the entire country. So if we zoom out here, I think it stops after a while if I zoom out. But so these are all the Class MA opportunities that meet the criteria and meet the appraisal criteria as well. And so I don't know where you're based in the country, Ian, but you can see there is no shortage of Class MA opportunities pretty much no matter where you are in the country. Even if you're right out in, I don't know, is this Lincolnshire or something? There's that little town there. There's a 90% opportunity there. So I'd like to think there's no excuse to find one no matter where you are in the country. I will admit they do get a bit thinner on the ground once you get up into the northeast, which is my part of the country, but there's still some going on up there as well. So there is plenty. If you get the overlay, Ian, you'll find them nice and easily. And then Michael's asked, I have an airspace with planning permission for 2 and 1 bed flats. Would Brickflow be able to assess the development costs for this?
So we don't assess development costs. That's on you to put the costs in. But we can certainly assess the funding. So as we've just shown, put the details in. You might not have a value for the air rights. It might be sort of in at 0 value, or you might have a residual value that you want to use. But if you already own it, then you'd probably just put it in as a 0. Put the build costs in, put the GDV, length of time to build and sell or refinance. You'll get your results, and then, as Andrew just demonstrated, go into the check eligibility and just look for lenders specifically that will lend on air rights, because not all of them will. So you want to select, you only want to shortlist lenders where it specifically says we will consider air rights schemes.
Yeah. And also, Michael, I would check out another company called C-Link. We did a webinar with those people, what was it, about 2 weeks ago now.
Oh yeah.
And they've got a platform that helps you understand build costs. So if you put in all the property details, it allows you to then sort of in a similar way, I think, get a lot of quotes back from contractors in terms of, I think they work with a lot of contractors, and they can then estimate the values accordingly. Is the Brickflow option available in the standard Nimbus Maps or Elite Plus only? No, this is regardless of whatever platform you're on. If you click on a particular property, if you scroll down to the bottom of the info panel, you shall see it is there. And likewise, if you want to get some pre-app planning reports, there's also something with mass reports. If you want to get a topographical survey, there's a button for that as well. So that's across all platforms. And I think we might have picked up all the questions Carl's asked. Someone's asked for the C-Link on here. I can't remember what their website is.
C-Link is Paul Hemming is the right. Yeah, okay.
Yeah, so it's C-Link. And if you Google that, you'll find their website. And like I say, it works in a very similar way. You put the property details in, and then it tells you about build costs. And then, like I say, so there's you can then work with all of them. So yeah, clink.com. There was one question I did see somewhere on here. Yes, well, there will be a recording of this, Kyle, so you can watch it back at a later date, although you might see that on the recording now. And I think that's everyone. I felt there was one other question. Was there one from? No, I think I've covered off everything. And we are 7 minutes overdue, but I appreciate there's still quite a lot of people on here. So I really do appreciate your time that you're putting in, and obviously Ian, to your time as well. But I think all that leaves really is to say thank you very much for listening. Really appreciate it. Thank you very much, Ian, for your time as well.
Thanks for having me, Andrew.
And
hope everyone has a great Christmas.
Yes, Merry Christmas to you, and Merry Christmas to everyone else. Although I will get to see everyone next week. We do have one more webinar before Christmas. The presents keep coming from, but I think
I had that slot last year. I think I was the 22nd or something of December.
Yeah, well, it is, yes, 21st is next Tuesday, and that's all about affordable housing. So if anyone interested in housing, do join us next week for that. But thank you very much, Ian. Really appreciate it. Thank you very much, everyone else, for your time. My name is Andrew Green, and we've been Nimbus Maps. See you all again next time. Thank you. Bye-bye now.
Cheers, guys. Thanks.